Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is an attorney and CPA, practices in the area of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. And Scott and I are both California practitioners, so that's important to bear in mind here as we're going through this. He is a certified specialist in taxation law, California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. He is a past president of the East Bay chapter of the California Society of CPAs, and in a past life, he was a sports writer covering Major League Baseball, National Football League, and other sports. Scott, thanks a lot for joining me today.
Thanks for having me. Appreciate it.
Okay. So today, Scott and I are going to be talking about real estate professionals and passive activity losses and things related to these subjects. These are very complicated areas, and so we want our viewers to get help from a competent tax advisor when they're dealing with these issues. This is just sort of an introduction to alert you to some issues related to this. Viewers who are real estate investors should get copies of Publication 525, which is a residential rental property publication from the IRS website, and Publication 925, Passive Activity and At-Risk Rules, is also at the IRS website, which is www.irs.gov. And I'm sitting here saying these are the greatest, but this is some really helpful information.
Starting point. It's a starting point.
Yeah, good basic information from the IRS. So with that, Scott, let's get into this thing. Is there a recent development for which more individuals will be more concerned about the passive activity rules?
Yeah, so let's take a drop back to sort of give a background of what passive activities are and what it was all about. And
all right.
We've had it forever. So before 1987, well, 86 is when the law changed.
Law was changed, yeah.
So in 86 and prior, we had these concept that you bought a rental property, multifamily, single-family house, some rental activity, and the depreciation was a lot more generous in those days, in the early days of the first Reagan administration, et cetera, et cetera. So you bought this thing, maybe didn't put a lot of money down, and you basically lost money. Maybe you broke even on the cash flow of the property, but you lost money because of this very generous depreciation. And people with other income from other sources, doctors, lawyers, dentists, other executives, that type of thing, they would say, I'm incented to buy these things because I lose on that, and I'm saving taxes because the tax rate might be 50% or something on my income. So I'm getting subsidized, basically. So somebody in Congress said, well, that's unfair. It's, no good, whatever. Well, there was a revenue raiser, and they passed this rule, and they said those kinds of losses are not available anymore to offset against wages. So what happened was all these losses came to a halt, making it no longer tax incentive to buy these things, etc. So then about 1993, the real estate community came along and they said, wait a minute, every other business in the United States, the milkmen and the farmers and everybody else, they can lose money and they get a tax refund for that, or tax credit or tax benefits. But real estate people don't get that. And the Congress said, well, yeah, I get you, I hear you. So if you're a real estate professional, meaning a broker, developer, manager, there's a whole list of categories found in these pubs, then you can take your losses on rental real estate just as if it was a farm or a factory or some other type of business that has nothing to do with real estate. So then everybody got excited and they said, wow, I'm back to where I was in 1985 or whatever, and I'm going to go be a real estate professional because then I can wipe out a bunch of other income. Well, not so fast, because to get these losses, let's say you lost $20,000 and we're talking about people that make more than $150,000 a year. So this is a wealthier category of taxpayer. you lost 20,000 and you say, well, I'd love to knock that 20 against my wages from my law practice or my dental practice or whatever. But you're not really a real estate professional because you're a dental professional or you're a lawyer or you're a doctor of some kind and so forth and so on. So the rule is, if you're truly a real estate professional, number one, and number two, if the activity is considered to be material participation, which we'll talk about, then if you had that 20,000 loss, then you can offset it against your wages, your dividends, your interest, your other income. So that's kind of the backdrop of where we're going with this.
Right.
Okay. Now, in 2013, enter a new concept, found at Tax Code Section 1411, the tax on net investment income, which is a surtax. It's a new tax. It's an additional tax over and above all the capital gains, depreciation, recapture, ordinary income tax, capital gains tax, all that other stuff that we've been dealing with. Now there's this additional thing, this 1411, net investment income. And one of the features of that is that if you have passive activity income, so you have a rental property now you're not losing because you've had it for a long time. You're not losing anymore. You're making money on this thing. Depreciation's all burned out, rents are up, mortgage interest is down. If you make more than $250,000 if you're married filing joint, you could pay this additional surtax on this thing if you're not a real estate professional. So it's truly a passive activity. So now you're further incented to sort of become a real estate professional. But you got the same tests. You got the same tests. So that's kind of the backdrop. That's the backdrop of what the new feature is in this area of real estate professional.
Okay. So one thing that I want people to understand, maybe I'll pass this by you. Has California conformed to this?
No, this is a federal rule, and you don't get the same. Two things. This net investment income, that's a federal tax only. It's not a state. It's not a California tax. And the second thing is, if let's say you have this special circumstance where you can write off the $20,000 on your rental property, you do not get that same deduction for California. That is said to be suspended, and that'll be used in the future.
Right. And it may be hard. I don't know how that works on TurboTax, but anyway, I mean, I know that it's a little bit of a pain in the neck for you and I as
yeah, it's a timing difference. But basically, if someone has net income of $200,000 for federal, they're going to have net $220 income for California because they don't get that extra 20 loss in my example.
Right. So I think we've highlighted then why someone would want to be a real estate professional. So one, they can take losses from their real estate properties where they otherwise couldn't.
Right.
And then the other is that now we've got this new additional tax.
Yeah, that's if you're making money.
Yeah. And,
so, in those activities.
So we'll get into some of that. But again, we've got a limited amount of time, folks. Complex subject. We have a whole other program that we did on net investment income. So you can find it at the website, financialinsiderweekly.com, under past episodes. I suggest that you take a look at that to get some more details there. All right. Do both a husband and a wife have to qualify as real estate professionals in order to get the tax benefits?
No, so that's the good news. The rule is written in such a way that if one spouse qualifies, then they're both considered sort of jointly real estate professionals. So husband's a dentist, working full-time, making $300,000 a year or whatever they make. Wife is, let's say, a real estate developer, and she's off doing her real estate development, and she works full-time in that activity. Now, the hours definition is, does she work at least 750 hours in real estate trades, and is it half her time?
More than half.
Yeah, more than half.
Yeah.
Right. So 750 works if that's all she does.
Yeah.
Now, if she's a dentist and works, say, 1,000 hours in that, and she works 750 in real estate development, then she's not eligible because it's less than half.
All right. Okay. Do real estate professionals report their rental real estate operations differently from other taxpayers?
No, generally speaking, we're talking about individuals now.
Yeah.
There's a Schedule E that's attached to your return, so you'll show your rents and your deductions, insurance, plumbing, repairs, mortgage, depreciation, etc. Then that's where the dichotomy occurs. If you're not a real estate professional, you might be limited to either some or all of that deduction. If you make more than 150, you have a loss on a rental property, you're not going to be able to take that. So that'll just stop there and there won't be a deduction. If you're a real estate professional, however, and you qualify for this, then that loss passes over to page 1. It actually does offset the wages and dividends and so forth.
Right. So I guess the main difference is going to be on the passive activity loss form. There's a passive activity loss form where you compute this limitation. And so for the real estate professional, won't make it to the passive activity loss form.
They don't even have the form in some cases.
Yeah. Okay, so again, let's sort of review for a moment again, or reiterate the requirements that have to be met in order to qualify. So we said, what, more than 750 hours, right?
In one of these real estate trades or businesses.
Right. And then more than half of your personal services have to be in this
That's
activity.
Correct. Now there's an interesting footnote there. One might argue that loan origination is a real estate activity because it requires, it involves in real estate and so forth. I had a case, and I only bring this up because it was a great disappointment. And somehow it's my fault, which it wasn't. Right? The tax preparer always gets blamed, right? So, gentleman came in, had a bunch of rental properties. He worked at a big bank as this employee, a loan originator, and that's all he did. And he was paid on commission, but he got a W-2. But he didn't own any at the bank. He says, well, I spend 3,000 hours a year originating loans doing a real estate trade. And the answer is no. If you work for somebody else, none of those hours counts as a real estate trade. So we're really talking about self-employed, effectively.
So yeah, it has to be for your own business.
Right.
Okay. And then you mentioned the thing about material participation. So you had to materially participate.
Right. So generally speaking, that means 500 hours in an activity. So somebody might say, well, wow, I've got a duplex, and I don't know how I could even spend 500 hours unless it was a valet service with the tenants or something. But then, in addition to those pubs, I think it's instructive, if you read the instructions to the IRS Form 8582, there, I think on page 4, there's an entire list of how you get to be a material participant. Are you the only one that does the services? Have you done it 5 out of the last 10 years? And those types of things. There's a series of those.
Right.
And so, and there have been court cases where those things are allowed.
Yeah. So basically, yeah, like if you work more than 100 hours and you're the only one,
right,
then it can still be material participation.
But
another important thing here is grouping of the properties and the election that's available related to that.
Yeah, that's correct. So let's say that you were a real estate developer, for example, and you worked in some activities which had nothing to do with your passive activities, and then you had additionally you owned a fourplex, let's say, and you lost money on the fourplex, but you just had it, but you were the only person doing it and so forth, and you spent 50 hours doing it. You can elect to group your real estate developer activities with your rental activities, and all of those hours are considered one big activity.
Yeah.
So.
And I think more importantly is you can make an election to treat all of your properties as one.
That's correct. That was going to be the second example.
Yeah.
So if you have 7 duplexes and they're 75 hours each, if you combine them, then you are 750. And if you don't have any other job, well, then that could be considered real estate professional.
Yeah.
For those activities only. And so that's one of the reasons why you might want to make this election, again, for taking the losses or for that person trying to avoid this new 1411 tax.
Yeah. So it's a little out of sequence here, that's okay. Because I want to focus on this election for just a moment, and that is, one is that this is really important. Once you make this election, this may be a golden item for you. This is one tax return you want to hold on to and keep it in a frame someplace.
Right.
Because the IRS is going to ask you to produce the election.
Right.
And you can say, well, I gave it to you. Why can't you produce it? No, you have to produce the election.
Right.
So anyway, So just be aware that this is a very, very, very important document. It's almost
Right.
like talking about your will or something.
Elections are as an attachment to your regular tax return, goes in on time with your tax return.
So yeah, it seems like no big deal when you do it. And the problem is that I see is that people throw tax returns away sometimes after a while, and they don't realize that they're quite often permanent records.
Correct, and this is one of them.
And or just, which tax return did I make that election on? You know, I mean, it's clear to you right now this year, but 13 years from now, you know, you may not remember. So again, this is something that really should be kept in a file someplace.
Well, there's another aspect of this election as well. Is it's conceivable if you're adding properties or if you're changing properties through exchanges, it's conceivable you might need to re-elect because let's say you had 5 properties last year and you elected to group all of those together, and then you sold 2 and bought 2 different ones. Well, now you have 2 different activities, and they're not really included in this original group. So you have to consider electing again. And if you don't, then you might not be able to take those hours in account with the other 3 that you retained.
Okay, that's a good point. So let's pull in again this issue. You know, maybe again to reiterate the point. If you have another full-time job, it's going to be pretty tough to qualify as a real estate professional.
Very difficult. I think I told you the example before about the guy who worked in lived in Solano County, California, at least an hour commute to San Francisco, had a job which was 7 to 3:30 kind of a job, commuting both ways by car or by commuter bus or something like that. And he had 7 or 8 rental properties, and so he had a full-time job plus all of his commuting time, which was 2,000 hours, let's say. So that means he had to have more than 2,000 hours devoted to these rental properties. And I computed, and I asked the guy, I said, well, based on that calculation, that's every Saturday and Sunday, 11 hours each of those days, plus 4 hours every other day, no days off, not Christmas, not Hanukkah, not any day. And he said, I did that.
Yeah, right.
And I said, sure you did. Show me your diary. See, this is the next thing. So the IRS will say, okay, if you did that, we believe you. Now prove it to us. So you have to have a diary, or you have to have some kind of evidence, not after the fact. It's got to be a diary, a date timer, something, where you wrote down what hours you were working, what you were doing, et cetera, et cetera, et cetera. And the other interesting thing is that not all of the direct input, if you will, on any property necessarily will qualify. If you're cleaning the toilets, that's not necessarily going to qualify, or they won't care. Or if you're analyzing properties, that's another classic cat. Or if you're making phone calls, those won't necessarily qualify as time committed to your activity. So it's pretty difficult, really, unless you're in a trade or business as a day job, to bring your investments along as a real estate professional.
Yeah. So if you've got something else that you're doing full time, and especially if you are, let's say, a serious professional, like you're an engineer,
right?
You know, Silicon Valley engineer that's working 12 hours a day or plus,
absolutely,
or you know, or a doctor or a lawyer that is very devoted to what you do and have a reputation, and
right.
So it's obvious you're doing a lot of studying and so forth. That's in addition to what you're doing at the office. So it just isn't going to be time, and so anyway, it's very, very tough. You know, I get people that walk in and say, "Oh yeah, I got these things, and I'm going to get my losses, and I'm going to be a real estate professional." And I say, "Yeah, sure. What do you do?" You know,
right.
And you know, I just said it's going to be, very, very tough, maybe even impossible.
Right.
Maybe we can make a list real quick of what are some real estate property trades or businesses that brings you into this real estate professional category.
Developing or redeveloping real estate, construction, acquisition, converting real estate, property leasing or property management, and a real estate broker would be those. And there was a case where the statutory scheme in California is that a real estate broker can deal with clients. A real estate agent technically works for a broker. Now the case fell in favor of the agent. The agent was working for a big national company, but not as the owner of the company. Nonetheless, she got to take the status of real estate professional because that's a licensing scheme. But you never really know. The IRS might try to cut you back on that.
Right. We talked about this business of making the election. Is there any relief available if you didn't make the written election?
Yeah, there's a rule that came in 2011, so you can make a late election. And so it's in. And I'm not going to sit here and try to read a book at first, but basically there's IRS guidance that tells you to when you can make the election, why you would make the election, and how you do it in a late election.
Okay.
So.
So you talked a little bit about some activities that don't qualify for the participation test. What are some activities that do qualify?
Well, something that an owner, collecting rents, finding the tenants, supervising the repairs, locating properties, those types of things would be more almost kind of executive, if you will, if you want to try to. But if you're a handyman and you're cleaning the floors or you're doing that type of stuff, it's not. It's just a different kind of labor that probably is not going to qualify.
Yeah.
But every situation is a little different. Every audit, you get an auditor, maybe get a friendly auditor. Who knows? I mean, who knows?
And there's another thing, that work done as an investor. So just studying and reviewing financial statements and financial analysis, those things don't qualify. You'd think that they would.
Yeah, you'd think so, but they don't. And one other thing that people lose sight of is out-of-state investments. Well, I'm on the phone 4 hours a night with my local property manager in Tulsa, and I'm in San Jose. Well, that doesn't really count because the guy in Tulsa is doing the activity with respect to that property, and the only way you bring that Tulsa property in is if you group properly on these elections, and if it becomes part of the bigger group, well, then maybe you can consider a deduction of this real estate professional status.
You mentioned this log business, so I want to go back to it for just a moment. So, part of the reason why people become self-employed is to try to get away from this stuff.
Right.
And so suddenly now they're back in a way being an employee for Uncle Sam.
Right.
They have to keep very detailed logs. And you and I were talking about a case. I mean, you may do the whole thing.
Right.
And still lose.
Right.
Because the judge says,
yeah, I don't
believe you.
Yeah.
This is nonsense.
Yeah.
I can see what you're doing here for your job. I don't see, it's just, it doesn't make sense.
You have to sort of review or understand the exam process. I suspect that many people are going to claim this status and they'll never get audited. They'll think they're pulling a fast one on the government. But if the IRS audits, the examining agent is going to be tough. They're trained. There's things in the Internal Revenue Manual where they sit you down and they kind of blindside you and they say, well, what were you doing generally Tuesdays? And then you're telling them a story and they're backfilling the story, and all of a sudden you've got more than 24 hours in your day. And how could that possibly be? And so you've kind of sunk yourself. And even if you get past that, appeals isn't necessarily going to agree with you. And then when you get down to the next level, which would be a tax court situation, the lawyer is probably just as tough or tougher than the auditor. And they know that you're going to end up in court and you're going to look like a fool in many cases. So, don't try this at home.
Yeah, it's tough. Okay, well, I think we've maybe paid enough attention to that, but again, you could even have the documentation and still not work. So maybe we should just sort of sum this up. One more thing before I move on to that. So we talked about the 750-hour test and so forth. Okay, so I make this election in 2013, and I meet the 750-hour test. Will I necessarily be a real estate professional in 2014?
No, every year is its own case.
Yeah.
So you have to keep meeting the test year after year after year.
Yep. So you may be a real estate professional one year, but not the next.
Right.
So I guess in summary, this isn't a slam dunk.
No, not at all. One reaction is I'll talk to wealthy executives or high income earners, engineers, doctors, whatever the case is, and they'll say, my husband needs to become a real estate professional. because we're really losing the benefit. Because you look at some of these tax returns and they're losing 60, 70, 80,000 net taxable loss that they can't use. And maybe, just maybe, it would behoove them to make these elections and to have that other spouse go into this business and qualify as a real estate professional. But when somebody comes to me with that idea, I always back them off a little bit in the real world and say, okay, yeah, these are tax deductions, but is it really worth it with all the brain damage that goes with doing all the real world, the logs and so forth? And remember, these losses aren't lost, they're just deferred. You will get them eventually. In fact, you may be able to sell a property and not pay taxes because effectively you've been churning up deductions that will trigger at the time you sell. I mean, that's the secret to this. It's a timing thing. It's a timing thing. So there's a lot of ways around this that have nothing to do with the seriousness here.
So one of the things, or two things that I want to mention related to this, and that is that the IRS sort of has two sides related to this. So one is that they put out some friendly information or like this revenue procedure that allows you to go back and make a late election for your grouping. That was nice, so that helps some people. But on the other hand, they've got a whole group, as I understand it, and a program that's going on that basically to identify, who's working in a full-time job and claiming to be a real estate professional, and they're just knocking these.
Right, and it's pretty easy. I mean, when you look at this one case I was mentioning, the husband and the wife were both working in 40-hour jobs, and their wages were approximately $200,000. They were making about $100,000 each. Those jobs are not part-time jobs. I mean, they're making some pretty serious coin, and you don't get that and have enough time left over. So that can be easily, because the tax return you filed says here, these people are claiming real estate professional status, and it has the wages, and you say, wait a minute.
It doesn't add up.
Doesn't add up, right there.
All right, folks. Well, we just have about a minute left. Okay. Maybe you'd like to just throw out a last thought, and then we'll wrap this thing up.
This can be a wonderful thing, but I think that lately the new business that I've gotten, and I prepared some tax returns, has been these people that have come around and either gotten audited or trying to be a real estate professional. You really need to understand the rules, and I think if you're really serious about this, you need to really think about hiring a tax preparer. Okay. Somebody who knows how to do it.
Thanks a lot for being my guest today, Scott. Folks, hope we've given you something to think about. Go and get that tax advice. See you next time on Financial Insider Weekly.